Hello, everybody, and welcome. This is going to be like I think literally like take three on this, but I feel a little bit better about it now, and we'll see how we do. So my disclaimer and copyright notice is that the information and opinions in this presentation are those of the author only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to those third parties. Okay. So what we're going to go ahead and do now is we're going to go ahead and do the big question, or this comprehensive earnings per share question. And let's go ahead and have some fun. Okay. So on December 31st, 2024, we had the following owners' equity. We had common shares. We also had some treasury stock. We also had options, Group A and Group B. We also had over here, we sold 70,000 treasury shares. We also issued some convertible bonds. And then over here, we had some of the Group A options that were in fact exercised. So what it also tells us here is that none of the bonds were converted during 2025. We had after-tax net income, and then we were subject to a 30% tax rate. And assume that the average stock price per share was $18 per share. Based on the above, compute basic earnings per share, which we always want to do anyways, and then determine diluted earnings per share. So here's what we're going to go ahead and do. So when we're doing basic earnings per share, what I need to know is like, well, how many shares that I have outstanding at the very beginning of the period. So on 1/1/25, which is the end of 1/1/24, we had shares outstanding of 1.8 million. Okay, so right over here, we had shares outstanding 1.8 million. Now, in terms of right over here, I sold 70,000 treasury shares for $18 per share. Now, if you watch some of my earlier equity videos, what happens is when we buy back shares, sometimes you will see companies turning around and reselling them, basically, and putting them back out into the open market. So if I'm selling 70,000 treasury shares for $18 per share, this is going to increase my outstanding shares because I am releasing them from the treasury. So this is going to be on 4/1/25, and this is going to be for 70,000 shares. Now, at the same time, over here, the bonds, I'm not concerned about those because those did not convert. Of the 30,000 Group A options, so these right here, right? Basically, I had these 30,000 options. 30,000 of the Group A options were exercised, resulting in the 30,000 shares of common stock. Okay, so on 10/1/25, we've got 30,000 shares that were issued. Okay, now these shares of stock are not all alike. What do I mean by that? Well, what I mean is that, well, this 1.8 million was outstanding for the full amount of the year. The 70,000 shares was outstanding for 9 out of 12 months. And this 30,000 shares was outstanding for 3 out of 12 months. So when I go through and look at this, I want to kind of come over here and say, well, this is going to be 1.8 million times 1. This is going to be 70,000 times 9 divided by 12. And this is going to be 30,000 times 3 divided by 12. Where am I getting 9? This is April 1st through December 31st. Where am I getting 3/12? This is going to be October 1st to December 31st. So my weighted average shares outstanding is going to be 1,860,000. Okay. So now coming over here, what I'm going to go ahead and do is my net income minus preferred dividends, which do not exist, divided by my weighted average shares outstanding. This is going to give me my basic EPS. My net income coming over here was 6,975,000. And my weighted average shares outstanding was 1,860,000. So my basic earnings per share is going to be $3.75. Very important number. Let's go ahead and now take a look at our potentially do our fully diluted or diluted EPS. Okay. So when it comes to diluted earnings per share, what I'm really trying to do is to see, well, which of these different items are going to effectively be diluted. Okay, so right over here. Okay. First one I think I want to go through and look at is I'm not really concerned with the Treasury shares. We can go ahead though first and look at the bonds, right? So let's take a look at these bonds. So what we need to kind of go through and do is we want to figure out what would happen if these bonds would have been converted, okay? And we could just assume they're going to be converted at year end. So the bonds over here, we'll assume that they've been, well, what if they were actually, it's not a year end, it's actually what if they were converted from when they were actually issued. Okay, so we've got 5 million bonds. Okay, we've got 5 million of bonds. And for the bonds, I need to figure out two things. My diluted earnings per share is going to be my net income. And remember, this is net income after tax minus the preferred dividend. And now we're going to basically add back interest expense net of tax, right? And the reason what we're trying to figure out is that if I'm going through and if these bonds in fact were converted at the beginning of the time period, how much would I have saved? So this would be the weighted average shares outstanding plus any dilutive securities. And the magical number I'm looking for is for $3.75. Okay, so what I'm going to go ahead and do here is I'm going to say, well, we've got bonds of 5 million. The bonds were dated 6/1/25. Bonds pay interest annually at 9% on May 1st. Okay. So if I look at the interest expense, right, and this is basically going to be at 9% or my interest rate. Whenever I see an interest rate, it is always going to be an annual rate. So my annual interest is going to be 450,000. However, that is not the droid we're looking for. Because why? The bonds were issued on 6/1. So these are going to be outstanding for June, July, August, September, October, November, December for 7 months. So I'm going to go ahead and multiply this by 7/12. When I multiply this 450,000 by 7/12, I'm going to get 262,500. However, this is a pre-tax amount, right? This was basically deducted. We had our operating income minus other income expense gives us net income minus income taxes. Remember, the 6,975,000 is after tax net income. So I need to effectively make this also after tax. What I'm going to go ahead and do is I'm going to multiply this by 0.7. Where am I getting the 0.7 from? Well, if I'm at a 30% tax rate, basically 1 minus 0.3 tax rate, or 0.7. So my add back is going to be 183,750 potentially. Okay. Now, so this is my interest expense, basically net of tax. Now, what I also need to figure out too is for these bonds of $5 million, how are they going through and converting? Well, we have each $1,000 bond can be converted into 24 shares of common stock. Okay, so over here, so each bond is $1,000. So basically over here, we had a total bond, basically each bond. So over here, I have a total over here of 5 million divided by 1,000 for a total of 5,000 bonds were issued. Okay. So now we've got 5,000 bonds being issued. And now, how many shares are going to be issued as a result of these bonds if they were being converted? Well, if we converted them immediately, each bond is convertible into 24 shares of common stock. Or over here, this is going to be 120,000 shares. However, was this 120,000 shares here for the entire year? The answer to that is no. These were issued on June 1st. So I have to multiply this by 7/12. So the number of shares to be issued, or the number of weighted average shares, would be 70,000 shares. Now, what I need to do here is to say, well, would this bring down the equation? If I have 183,750 divided by 70,000, this is coming up with a value of $2.62.5, right? I would just call it 263. Okay, so right over here, so essentially, this is in fact diluted, and we're going to go ahead and include this in our equation. So let's go ahead and just kind of add this in. So for our diluted, we've got the 6,975,000 divided by 1,860,000. That's not going to change. Now we're going to basically be adding to this the bond of 183,750 divided by 70,000. Okay. So over here, we've got basic. We've got the bond, and we've determined that this is dilutive. Why is it dilutive? Because it's bringing down, right? This is basically going to be, if I add this in, it's $2.63. That's going to bring down my basic earnings per share. Okay, so we've dealt with the bond. Okay, so now let's go ahead and take a look at our next ones. So over here, we see that with regards to the stock options, and I just did a video of 1.9, a little bit out of sequence right over here on the last video. You can find that on video 1 of this series, but I kind of go through about how to go through and to handle this. So we're going to use the same methodology. But of course, there will be complications because we exercise some of these bonds, some of these options. Now, the first thing is, what is the stock price? Okay, if the strike price, meaning what I could buy it for, is higher than the average price per share, I'm going to ignore this right here. But remember, as I showed you before, when it comes to disclosure, I'm going to need to go through in my footnotes to my financial statements. I'm going to have to say, hey, these are the shares that we did not include because it was anti-dilutive, right? So this here, Group B, I absolutely do not care about Group B for my computation purposes, but for basically for thoughts over here in terms of thoughts over here basically for the whatchamacallit. Just I don't care about Group B, but I do need to disclose it. So let's go ahead and focus our time on A. Okay, now a couple different ways we could do this, right? So essentially with Group A, okay, so now 30,000 of these shares were exercised, right? So we've got over here 30,000 were exercised, but 70,000 . So what I can do is I can kind of go through and break these up. But why am I going to break these up? Because these were exercised on October 1st. But when we go through and do our dilutive earnings per share computation, I have to now account for those other 9 months. Because remember, this over here, we basically did the 312. So I now need to kind of go through and basically pick up the other 9/12s. So let's go ahead though and now try to go through and figure out how are we going to go through and to value these different options. Okay. So the first thing is let's go ahead and do the 70,000. So if I sold the 70,000 shares, or if I exercised 70,000 shares on 1/1/25. Okay. Again, this is a hypothetical which we're using for fully diluted or for diluted, right? So my proceeds would be 70,000 at $18 market price per share. So this would be 70,000 times 18, or over here, this is going to be 1.26 million. Okay, so these were outstanding for the full year. I'm separating these out. So I've got basically 70,000 and $18 market price per share, but these are not free. So the cost to me is going to be 70,000 times 9 strike price per share. So the profit on the 70,000 is basically going to be right over here, is basically 630,000. Now, what the real question is if I took this 630,000 and how many shares could I buy on the open market? Well, if my profit is 70 grand, and if I could go out and buy at $18 per share, which is the market price, this would basically result in 35,000 shares being issued. Okay, so this would result in 35,000 shares being issued for the options that were not exercised. Okay, so we're not done yet though. Okay, now these 30,000 options were not outstanding for the full year, but let's go ahead and kind of do this computation as well. So when we rephrase this, this is not exercised. And then we'll say exercised 30,000. And what we're really looking here at is the period of 1/1/25 to 9/30/25, because these would have been exercised because they are in the money. So the proceeds are going to be 70,000 basically times 30,000 times an 18 market price per share. Okay. And now, same time over here, the cost is going to be 30,000 times 9 per share. Okay. Or 270. So my profit on the 30,000 is going to be 270,000. Bottom for 9, doubled my money right over here. So now my profit is going to be 270. My market price is basically going to be 18. Okay, so right over here, I'm coming up with a value of 15,000. Okay, however, this is for the full year, right? So what I need to do is I need to make an adjustment. I need to multiply this by 9/12, or 11,250. So as we know, these are both going to be dilutive. So let's go ahead now and put these in. So just to kind of recap this, right? What I'm really going through and doing is I'm basically saying, okay, when it comes to options, right? We take a look at the market price and we compare it to the strike price. If the strike price is higher, forget about it. We're not going to be concerned with that. However, if the strike price is below, we have to make an assumption that they would have been exercised. Why did I split this up? Because it told me that 30,000 of the Group A shares were exercised, resulting in the issuance of 30,000 shares of common stock. So what I have to really kind of do is to say, well, of that 100,000, 70,000 was outstanding for the full year, and then 30,000 was just for those first 9 months. That period of time they were not exercised. So here I'm going to basically take what are my proceeds, what's the cost, and then how much on the open market could I have actually purchased with that profit. And I'm taking that amount, dividing it by the market price. Over here, same kind of concept, except the only difference here is I'm basically multiplying this by 9/12 because this was the period that those options were not exercised. So right over here, I've got 11,250. Let's go ahead and put that into our equation. Okay, so we've got the basic, we got the bond, we got the 70,000 not exercised. We got the 30K exercise. So for the 70,000 options, we basically said it was 35,000. For 30,000 options, we said it was going to be 11,250. So my total over here is that I'm going here. My basic is 1,860,000 plus the shares that would be issued as a result of bond, plus the 70,000 shares of the option, plus the 30,000 shares of the effect of that other option. And coming over here, I've got 6,975,000. Now, why am I adding this back? Because if I added this back, because if I issued the stock at the beginning of when the bonds were issued on June 1st, I would not have had to pay this interest. So I'm adding this back. When I add back the interest, remember when we see net income, it's after tax. So here I got to make sure that I'm adding this back on an after tax basis. So here get to 7,158,750. And when I divide this over, I'm coming up with $3.62. So this, in fact, is below the basic earnings per share. The options are always going to be dilutive, right? If I added in out of the money options, I would have a problem. But if it's in the money options, it's always going to dilute it. Over here, the bond, as we showed, this is going to be below the threshold of this over here at $2.60. So that is my earnings per share. Wow, it's exciting. Now, I do want to apologize to my former students because as I was going through and doing this problem, I realized that my answer key was wrong from 4 years ago. But I'm pretty sure I added a pretty fair amount of extra credit and difficulty points. So I do make mistakes, but I do want to apologize to that class in the spring of 2022. I know many of them are already CPAs, so I hopefully could not have led them on too wrong of a journey. So in any event, I want to thank you for being with me here today. And also I have on my very first video that I did for this sequence on YouTube, let me show this real quick. So this will be published soon, but on this very first video, I took the time to put all of my walkthroughs previous videos that I've made with Wiley. So all of these here, you can basically link to and copy them and see if you're taking, remember, this is for the 17th edition. And these videos like 4 years ago, they're now like on the 19th edition. Biggest changes, instead of chapter 16, it's going to be chapter 15. But in any event, I hope this helps. Thank you for watching. Please remember to like and subscribe. And if you want to leave a comment, please feel free to do so below. If you have questions, email me at ibc30tocpa@gmail.com. I'll see you on the next video. Have a great day.